It's 1997, and a massive currency crisis is absolutely tearing through Asia. I mean, entire economies in Thailand, Indonesia, and South Korea are collapsing practically overnight. And what do these governments and panicked citizens scramble for? It's not gold, it's not euros, they are begging for US dollars. Fast forward to the 2020 COVID panic, and we saw the exact same thing happen. Banks in Brazil, factories in Germany, oil fields in Saudi Arabia, they all raced for the exact same green paper you might literally have sitting in your wallet right now. So today, in this explainer, we're going to unpack the incredible geopolitical architecture that makes this possible. Let's dive in. Here is our syllabus for today. We'll cover 1. The global monopoly. 2. The Bretton Woods era. 3. The petrodollar loop. 4. The consumer impact. 5. Modern challengers. And finally, 6. Internal risks. Starting right off with Section 1, the global monopoly, before the dollar. To really wrap our heads around American financial dominance, we actually have to go back to a time when the United States wasn't even part of the conversation. For most of the 19th and early 20th centuries, the whole world ran on the British pound. If you were a merchant in Shanghai buying tea or a trader in Cairo dealing in cotton, you settled everything, the whole shebang, in pound sterling. It was backed by gold, it was trusted globally, and its dominance was completely undisputed. Britain ruled the waves, right? And its currency was the true backbone of global trade. But then, 2 world wars changed absolutely everything. By the time we hit 1945, the global economic power dynamic had violently shifted. I mean, look at the contrast here. Britain and the rest of Europe were essentially bankrupt, deeply in debt from years of fighting, and literally bombed into rubble. But on the other side of the Atlantic, America was sitting on untouched factories running 24/7, feeding and supplying the Allied forces, plus the US was holding more than half of the entire world's gold reserves. It's safe to say the financial center of gravity had officially crossed the ocean. Moving on to Section 2, the Bretton Woods era, redesigning money. So, that dramatic shift sets the stage for what is arguably one of the most consequential meetings in human history. It's July 1944. Delegates from 44 countries meet at the Mount Washington Hotel in Bretton Woods, New Hampshire, basically to rebuild the global financial system from scratch. And 2 brilliant minds end up clashing over the future of money. You have John Maynard Keynes, representing a fading British Empire, proposing the Bancor. This was meant to be a completely neutral, shared global currency designed so no single country could dominate. But Harry Dexter White, representing the United States, well, he knew exactly how much leverage America had. He pushed through the US dollar peg. This meant every currency would be pegged to the dollar, and the dollar would be pegged to gold at $35 an ounce. America flat out refused to surrender its new leverage, and as a result, they were handed the keys to the global financial kingdom.
For decades, this Bretton Woods system held strong. But fast forward to 1971, and rising inflation combined with massive government spending forced President Nixon to shock the world. He abruptly closed the gold window. Suddenly, the dollar was floating. It was no longer backed by gold. Panic ensued, of course, and plenty of economists at the time predicted this was the end of dollar dominance. But instead of collapsing, the US orchestrated a really brilliant geopolitical pivot just a few years later in 1974, finding a brand new anchor for its currency.
Which brings us to Section 3, the petrodollar loop, black gold. That new anchor? It wasn't a shiny metal. It was something the modern world literally could not survive without. Enter the petrodollar system. In 1974, the US makes this incredibly strategic deal with Saudi Arabia. America agrees to guarantee military protection for the Saudi royal family. In exchange, Saudi Arabia and eventually the rest of OPEC agrees to sell their oil exclusively in US dollars. Think about that for a second. The greenback went from being backed by gold to being backed by the world's most essential commodity, black gold.
Let's examine the mechanics here, because this 3-step process is honestly a stroke of genius. Step 1. Every single country on Earth needs oil to run their cars, their factories, their airplanes, right? Step 2. Because of that Saudi agreement, they absolutely must buy that oil using US dollars. Which leads to Step 3. To ensure they can always buy oil and keep their economies running, countries are practically forced to constantly stockpile massive reserves of US dollars. It creates this mandatory, self-reinforcing loop of global demand. Because everyone uses the dollar to buy oil, everyone else is forced to use the dollar too.
Section 4. The consumer impact. Your cheaper coffee.
Now, as students of finance, you might be thinking, okay, this is fascinating geopolitics, but what does it have to do with me? Well, it changes everything about your everyday life. Decades ago, the French bitterly complained that the U.S. enjoys an exorbitant privilege. And honestly, they hit the nail on the head. Because the whole world desperately needs dollars to buy oil and conduct trade, the baseline demand for the currency stays incredibly high. This unique setup allows the U.S. government to run massive deficits, borrowing trillions of dollars at artificially low interest rates simply because global lenders are always lining up to buy our bonds.
So the absolutely crucial question here is, how does foreign central banks holding billions in reserves actually impact your local grocery run or your receipts at the gas station? It's simple, really, because global demand keeps the dollar so remarkably strong, your purchasing power as an American consumer is artificially elevated. That smartphone assembled in China? Cheaper. The average prices you pay for groceries, like your morning coffee made with beans from Colombia? Cheaper. Auto parts manufactured in Germany, or the fuel prices you pay at the local gas pump, all of it is artificially cheaper. This exorbitant privilege is the primary reason everyday imported goods remain so affordable for American consumers. The rest of the world's need for your currency is directly subsidizing your lifestyle.
All right, Section 5, Modern Challengers, Crypto and Rivals. Of course, no monopoly lasts forever. Unlike the unified agreement we saw at Bretton Woods, the current state of global currency markets is filled with challengers trying to dethrone the dollar. But, as you can see, they all kind of stumble. The Chinese yuan? It's heavily controlled by its government. It lacks the free market convertibility that international investors absolutely demand. The euro is held back by fragmentation. You have 20 nations sharing money with no unified fiscal treasury. The proposed BRICS currency struggles with deep political distrust among its own members, like those ongoing border disputes between India and China. And what about Bitcoin or crypto? Well, they are simply too volatile. Central banks are managing the life savings of entire nations. They require extreme stability, not an algorithm that can drop 50% in a single month. So, right now, there just isn't a viable alternative to the dollar. Finally, Section 6, Internal Risks, Sanctions, and Debt.
Look, just because there are no strong external challengers doesn't mean the dollar is invincible. The real threats, they're self-inflicted. $34 trillion. That is the current U.S. national debt, and it is climbing. America currently pays over $1 trillion a year just in interest payments alone. The entire dollar system relies on the absolute certainty that the U.S. will always pay its debts. If climbing interest obligations ever make global investors doubt that capability, the fundamental trust propping up the dollar is going to erode.
And compounding that massive debt is domestic political instability. When foreign central banks look at the U.S. and see reoccurring debt ceiling crises, government standoffs, and historical credit downgrades, well, it creates unease. The manager of the world's reserve currency really cannot afford to look politically unreliable. Simply put, it spooks the markets.
And then there is the weaponization of the currency itself. $300 billion. That's the exact amount of Russian central bank reserves that the U.S. and its allies froze overnight following the invasion of Ukraine in 2022. It was a truly unprecedented demonstration of the dollar's reach through global financial sanctions.
Now, neutrally speaking, while this certainly showcases ultimate U.S. financial leverage, it introduces a severe unintended consequence. It creates deep, deep anxiety. When nations realize that their sovereign wealth can basically be turned off with a keystroke in Washington, it naturally motivates them, even neutral or allied countries like Saudi Arabia, India, and China, to quietly start diversifying. They begin trading outside the dollar system, hoarding gold, and hedging their bets, just in case they ever end up in the crosshairs.
Which brings us to the core takeaway of this entire masterclass. The dollar didn't just rise to the top by accident. It was forged in the wreckage of World War II, it was cemented by the Bretton Woods system, and it's been protected by the petrodollar loop. But as this quote reminds us, this intricate, towering system survives solely on a fragile foundation of global trust. It is without a doubt the single most powerful financial instrument in human civilization, but it's not immune to gravity.
So, I want to leave you with this provocative thought as we wrap up today's explainer. The next time you look at the money in your pocket, I want you to consider the geopolitics, the towering national debt, and our rapidly evolving global landscape. Will the US dollar still be the world's reserve currency in 50 years? Let that sink in. All right, class dismissed. I'll see you in the next one.